Good morning, everybody. It is Tuesday, December 15th, 2020. This is the covered call, and I will give you a couple of updates right now. First off, fundamental trends. We have the developer working on it today to make it even more functional. And I am going to be adding model portfolios for folks because you keep asking, and I'm finally going to crack. And on January 1st, we'll have model portfolios with a spreadsheet of the buy and sells rather than just going through the website to find them. We'll have it all on Google Sheets for you. And we're going to have a sustainable growth portfolio and then a dividend collector portfolio, which will have an add-on for options. So there will be the stock portfolio, and then there'll also be the options that portfolio trades as part of retirement income options. So that'll all start on January 1st. I'll put a couple of starter positions in on that day, the first day of the trading year, which I think is the second, might be the third. And then we will have a nice, easy to follow, plug and play approach for folks. I know it's what people want. It's not entirely the right way to approach things, but I think it's good for the learning process, so we'll do it. Today, we're going to take a look at about a dozen stocks and talk about when you should be selling a cash secured put to try to acquire a stock or build a position or just generate some extra premium to reduce your cost basis, as well as several stocks to sell covered calls on. And I'm just going to start with some screening. The very short list, this is the expanded version. You can see the plus sign. It's not only stocks that are on the very short list, but stocks that have been on the very short list, as well as companies that we thought about putting on the very short list. So it's 266 stocks. We don't follow that many right now, follow closer to 180 to 200, but there's 70, 80 stocks that we've taken a look at in the past few years. People have legacy positions, so we'll follow those. What I would like to show you is that there's an awful lot of relative strength index that's very high right now. That's been a recurring theme for about a month or two, and this is a daily measurement. So these are the daily RSIs. And with any stock, to really know when you should be selling it or selling a covered call, you really need to look at the weekly RSI. So we're just going to look at some of these companies. I will actually pull one that is on our list and one of our favorite stocks, which is CRISPR. And I will show you something here. So with CRSP, CRSP, we can see that the RSI on the weekly chart is also screaming higher. So it wasn't just the daily chart that had a high RSI, it was the weekly. So when weeklies get this overbought, you should pretty much universally be trimming your position, and you can write covered calls. So with this, take a look, we pull it back, squeeze this down to get a better view, and we say to ourselves, all right, what kind of a breakout is this? Well, it could be that it's just screaming up because stocks are screaming up in certain sectors right now. I haven't looked at the news on this, but what I can tell you is that in this range, the whole point of buying it in here was to get one of these moves. So now that it's closing in on a pretty high target price, I would say you probably want to trim back and write covered calls so that your cost basis, if it crashes, right, you don't lose money until it goes below 117 from here. So that means that you should probably trim at 150 down to 117. You really need to trim about a fifth of your position, right, to represent the difference in this price and this price. So take about a fifth off the table, maybe a quarter off the table. And for me, I would probably write a covered call at 170 just to take in a little bit more premium and to trigger a sale up here. So if we take a look at an option chart here, put in CRSP, 170 is a strike price I want to see. and put in a January. So the 170 covered call is going to get you about $8, $7 or $8. So you go back to CRSP here, you trim about a fifth of your position, maybe a quarter of your position, right? Take some profits off the table, and then you can write a cover call on another quarter or fifth of the position at 170 and collect $7 or $8. So if you have 1,000 shares of this and you sold 200, 250, 300 shares, take that money, put it back in your pocket, and then sold 2 or 3 covered calls up here. And again, depending on your risk tolerance, now what you're doing is saying, okay, I feel pretty good even if this falls down to around 120. And can we lift this buy range? I don't think that we want to lift the buy range. However, it's seeming more and more like we can at some point if this breaks through here, right? So if it breaks through here and we get news with earnings that is somewhat justified, then maybe we would drag the buy zone all the way up to here. For right now, I'm leaving it here because what I am seeing is that the price to revenue is incredibly high. So we can just go here, get our little summary here. It's still right. It's still negative earnings. You can pull up the research report and say, okay, what is the revenue? Still not all that high. We'd like to find the price to revenue. Ratios will have ratios, right? A lot of warning signs here. Price to cash flow is not so good yet. Price to cash flow, price to book is high. Price to book of 8. I mean, that's, tough. But here's your price to sales. I mean, that's not what you want to see. You want to see a number under 10. So not good fundamentals across the board. This is betting on a hope and a dream. I do think it's good technology. I do think it's going to get used. But you have to ask yourself the question, at what point do they make enough money? Right? It's a favorite stock. There's no doubt about it that it's a favorite stock of a lot of people in this market. They're sitting on enough cash that they're not going to be threatened. But this is one of those things where, almost without knowing that it's overvalued by a lot, you just look at that straight up candle and that chart and say, okay, why wouldn't I take profits here? And the only answer is because it's going up. So again, depending on how good of a trader you are, I think that you should probably be taking, a solid 20 to 30% off here and writing covered calls on another 20 to 30% to get $8 at the 170, which is probably going to be a line of resistance. I think is probably a pretty good deal. So when you're taking a look at stocks, you just take a look at these charts and you go, okay, you can't just say it went up like that, so you got to get rid of it. You look at the history and say, okay, that was the correct buy zone. We have that nailed. And then there's your breakout. Take some of that money and put it in your pocket. One of the companies that I was going to cover today anyway was Barrett Gold. I'm going to flip over to selling a cash secured put on this. And again, I don't know what your position is. I have I'm almost at a full position now. So for me, with almost a full position, I don't want to add any more Barrett unless I can get it down in here, which is the bottom of our, primary buy zone. So for me, I would probably sell a $20 put, given that it's been selling off recently, with the idea that it gets put to me at $20. And if I did that, if I sold a $20 put for January, I'd get nothing. So you don't sell the put. You just say, okay, well, maybe I just set a limit order here down at 19, right? We see that these levels in here are pretty strong. Get your jitterbug right there. Say, well, if it comes down to 19 and I already have a pretty good position, that's where I'd probably buy more. 18, 19, 20. Now, if you don't have a position and we can see that there's very little premium in the puts, which means that the risk is lower, I think you, again, like I've been telling you for the last few weeks, you can nibble in this area to get your starter position. But there really isn't much in the way of selling cash secured puts. Newmont, S&P 500 hasn't really come down yet, but some of the gold stocks are. And I just want to show you, this is a low volume area. So for this stock to come down into here on a correction in the S&P 500 before it gets back to a high volume area is not unlikely. And this really could come all the way down to there. This could come all the way down to here in a worst case scenario. So do you sell a cash secured put here? That's a question that people are asking. And I don't think so. I think you wait for it to get to here, then you sell your cash secured put. And I'm presuming that you all have a position in this because it's one that we've been talking about for better part of a year. If you don't have a position, maybe you take a starter position here around 53-ish, and then you also sell a cash secured put lower. But I wouldn't sell the cash secured put and buy the stock on the same day, right? Make a decision. Which one do you want to do when it gets to about here? And then do one that day, and then you can do the next one when if it gets down in here. So if it falls to here, which is going to be a support level, we don't know how strong, low volume area, so it might not be very strong. And we know that the moves through low volume areas can be quick and hard. See how this worked? Low volume area has jumped up, low volume area fell down. So in these low volume areas, your moves will happen faster. So be very careful when you're buying and selling when you're seeing low volume here, especially where there's a change, right? So if it was just low volume all the way up, it wouldn't tell you much. But because you got some volume here, which is people taking profits, clearly it's people taking profits because the price came down. So right around here is where you start going, okay, that's kind of the absolute bottom of the volume. And now you're going to start picking up buyers again. There's really nothing in premium on this one either, but I'll show you. It'd be more than Barrett though. Go out to January, just stay near the money. You pretty much always want to stay near the money. Say, okay, nothing on a $55 put, $49 put. There's no point in selling puts down here. You have to get closer to the price that you want. Now, if you own the stock and you haven't taken profits yet, and you're just going to ride it out, I would probably throw a $60 covered call out there. Take a buck or two off the table. I do think it's a stock that goes to 90 or 100 in the next couple of years. So don't get too cute. But while the support isn't there, go ahead and sell that $60 call and let it expire on you. Take a couple bucks off the table. All right, let's run through some stocks people asked about. Illinois Toolworks. It's a little bit more expensive stock, right? $200. So to sell one put, you've got to have $20,000 sitting there to buy the stock. I just want to show you something. If you go further back, right, stock has had this heck of a rally since the financial crisis because of all the money put into infrastructure, right? About $2 trillion under Obama. They keep talking about more. You get your tax cuts, get your quantitative easing. At what point do we have to pay the piper? I think the Illinois Toolworks is too high to buy here. I wouldn't bother selling a cash secured put. It would need to get down through this low volume area and back into this box for me to think about doing anything with it. And I think, see how this was resistance, it broke through, came down, came back up, came back down. So this area right about here, right, that's pretty strong support, which is why we have our buy box there. So I would want to get it down in here somewhere if I'm going to bother with Illinois Toolworks. Home Depot, same thing. Take a look at it. Just a juggernaut since the financial crisis. Quantitative easing, shovel ready, shortage of housing, millennials getting into the housing space. I think this is one of the few stocks where we can probably come a little bit more recent. We don't have to look as far back. I think 2016, where we had the sideways market for a couple of years, is probably the baseline, as low as it goes. Here's your coronavirus crash. Proves the theory. It's about as low as it can go. Therefore, this is our buy area. I've been getting rid of that yellow fill-in to make it easier to read. I don't think that there's and again, expensive stock. You got to have $25,000 to sell one put. I think you need to wait until we get much closer to the buy zone to do anything with Home Depot. And if you're in love with Home Depot, here's kind of the top, right? Resistance, resistance. Could it be support now? Well, one of the things we've talked about is, what if we throw this out? What if coronavirus was an anomaly and it doesn't really reflect where we are anymore? I'm not sure that I believe that. I'm just saying, when you're playing with the charts, maybe you can throw this out to see where your true ranges are. I think that this shows the bottom of how bad things can get on an event or a double dip recession. I think the top shows where it wants to stop going down. Then in here is the decision zone. And remember, you can overshoot a little bit any level, right? Have your false breakdown or your false breakout. I think that here, this is unlikely to be held. I think it gets back down into here, and I would be willing to buy Home Depot in the low 200s. Below was even better. This drop right here tells me that this is probably as bad as it gets in the future. I don't think you see this again. We'd have to have a pretty significant double dip recession, and I just don't see the governments allowing that to happen. And when some people say they don't have a choice, they have a choice. They can spend a lot of money. Maybe one of the bigger rebound stocks here, Six Flags. Now, I don't think that we're going to have the greatest Disney and Six Flags season this summer, but I think by autumn, you probably see comparables that are pretty good 2 years ago to 2019. So the question you have to ask here is, what's going on? Well, it came out of a heavy buying zone and is going into a low volume zone, which means what? It could definitely shoot all the way back up here to the upper 40s, 50-ish, pretty easily. So I would not be selling a covered call here. I would want to see if, okay, well, if I bought it down here, this is my breakout on this low volume before it runs into resistance, right? People who bought up here that lost money and now they want to take their tax loss or break even. As it gets up into here, you can write covered calls or take some profits. Writing covered calls up here, I think, makes a lot of sense because I think it has a lot more to run. It just might take a while. So if it gets to here and jitterbugs, those are great spots to write a covered call because you collect some time value while you wait for it to take the next leg up. Would I sell a cash secured put here? If I could get some premium for a $25 one, which seems to be where it broke out from, let's take a look. Can you get anything for the $25 put? Nothing. So if it dropped a couple bucks and you wanted to write a put, right? If it got closer to 25, 26 to fill that gap, then you probably get a little bit more money for it. The question that you need to know if you're going to be going after Six Flags is, are they really going to break back out up here in the next year or two? I think the answer is probably. Like I've said, I think that people are aching to get out. I think a lot of us are tired of being cooped up. And I think that watching a lot of older people die, folks who are lonely at the end of their life now because it's hard to take visitors, I think a lot of us are coming to the conclusion that I better get out and live my life. So if I want to go ride that roller coaster or fall off that edge thing that they have, I think they changed the name, I better go do it. So I think that there's going to be a lot of folks going to casinos and flying to beaches and going to amusement parks, even theaters when they get those up and running again, probably starting in the summer and into the fall. I don't think that we're fully recovered until 2022 because there's a lot of financial household repair that has to go on. But people will put off investing in their retirement to go on vacation. We know this is a fact. So this one, if it comes back down here and fills that gap at around low 20, 25 and a quarter, I think you can sell a put and probably buy the stock. In fact, I'm going to look a little deeper in the Six Flags because it might be something that we want to add to the very short list as a potential double on a normalization. So let's get into a little technology. I got Hewlett Packard, And somebody asked about this, and it was also pretty overbought on the weekly. Take a look at this line that doesn't want to go through, right? Had the false breakout, came back down below it, tested it again, testing it again. But wait, there's more. Look at that. You can go back a long time. It's a wide range, right? But your volume indicator kind of showing you where the floor is, and then the end of buying volume showing you where the ceiling is. So right now, right, this goes back a long time. It's 20 years. That's a pretty easy to read chart, isn't it? So unless there's something new and improved about HP, this is one that you probably should be trimming if you own it, right? You should probably be trimming if you own it. And if you wanted to hold it long-term because it pays a dividend, I think it's like 3.3%, write a covered call. So if this is a stock that you hold, you sell the covered call here to collect some premium, knowing that it's going to probably jitterbug, just stay range bound. And it's a wide range. Now, not the type of stock that I want to own, because I don't want stocks that are range bound forever. AT&T is going to have a similar chart to this, but I think AT&T in the next couple of years is going to break out to a higher range. I don't know that about HP. Maybe you know something about it that I don't. I haven't studied it all that in depth. But if they have a reason why they can break out, you know, this is a low volume zone up here. I mean, it could go pretty high. So if you have an intrinsic valuation calculation on this, if you've modeled this out and said this should really be a $70 stock, it can get there in a hurry if you're right. I haven't done that modeling on it because it just hasn't caught my attention in any special way. Alibaba, on the other hand, I think is going to make tons of money in coming years. I think it's going to be a $2 trillion company. The Chinese government is tamping them down to keep some control over it, but ultimately China needs the capital and China needs the winners. So Alibaba has been jitterbugging and ups and downs, a big down candle there. Let's just look at this a little closer. If you don't own Alibaba, look at this little jitterbug zone. If it jitterbugs here, probably take your starter position. I already did. And I'm like dead nuts even on this one right now. I mean, I think I'm $2 or $3 up. No, it's down to $2.53, so I'm $2 or $3 down. I think my cost base is $2.56 is what I said. Now, if you believe that it's going to fall a little further just because it's still in a low volume area, take it that not a lot of buyers right here. Historically, hasn't been a lot of buyers right there. They like to get it down here, closer to 200. I think you can take a starter position here just in case the world's a little different, just in case it really was about to have a huge breakout, right? Because this buy zone looked like it was right. It started to break out. Chinese government gave them a hard time. Last time that happened was back here. So if you want a margin of safety, you know, probably wait till it's 200-ish to buy. But if you just wanted to get a nibble in, get a taste of it, right? Like the old mobsters, give me a taste. Probably take just a really small position here, 0.5%, 1%. Could you sell cash secured put? Well, if you've got 25 grand laying around for it, yes, you could. So a 260 gets you 13 bucks. So that gives you a net cost of 247. Still pretty high in the buy zone, right? But maybe more likely to be put to you, which is maybe what you want. So maybe instead of taking that first nibble, that first 1% position, maybe if you want to sell a 250 put or even a 255 put and just take premium to get yourself a net cost down lower, you can do that. Again, you have to have a pretty big portfolio for 25 grand to be 1%. Somebody asked about this cyber ETF, cybersecurity ETF. It's not something that I'm hugely in love with. I think it's out of its rally zone. I just don't see the whole sector skyrocketing up. So I think this is probably a sell right here, an outright sell, at least for big portion of your position. So if you were lucky enough to buy down in here, I'd probably be selling half of the position because it's unlikely to break out and run any further. You know, there's not a history of it. The underlying stocks aren't going to tell you that that's what's going to happen. And the nature of security is changing anyway. So a lot of those firms, I think, are threatened by innovation and change from their competitors. So I'd be selling cyber outright, mostly. You want to write some covered calls on what's remaining, go ahead. SunPower, somebody asked about selling a cash secured put on this. I guess that's an interesting thought. And take a look at this chart long term. It's getting to that spot where it could break out, right? It could do this again. I mean, just, what a history, right? I mean, talk about to the moon and crash. But it's getting to that spot where you could be seeing a breakout again. This isn't that long ago, right? So would I sell a cash secured put? If I'm in love with this stock and I think it's going to break out, I guess you could sell a 20-ish cash secured put. This is presuming you don't own any yet. 22, well, that was right at that support level. I mean, if you want to collect a buck, give or take, on the 22, you could do that, I think. It's kind of right where you think it might jitterbug for a while, and maybe it'll get put to you. You know, I don't know how much the fibs and the charting matter right now, so I would be real careful. I do think that there's a pretty good likelihood that we get a halfway retrace, so I do think that this is not unlikely. Give me 1 minute here. All right, thank you. I'm back. I had one very agitated dog at the door. I don't know if you could hear it, but he was giving me a hard time. I had to ask him what was wrong. He said, treat. I was like, cut it out. You don't do that to me while I'm on air. All right, so let's move on. Something else in energy, Occidental, one of the crappiest companies in the world. And look, about to go into a low volume zone. Who are going to be the buyers up here? Who didn't play this rebound is going to be a buyer. So I think you should be trimming your position because from a secular standpoint, it's a company in decline. I know that people want to say, well, but we're still going to be using oil for 50 more years, but less and less of it, so the volumes won't support the debt. It's that simple. The volume of the oil that's going to be demanded won't support the debt that's been generated. So this stock will come back down into this price range, not if. It's a question of when this is going to happen again. And there's very few buyers. So I'd be trimming the position here in case it didn't make it all the way up to 24, which is a pretty significant resistance line. I think 12 in the intermediate term is more likely than 24. Might get to 24, but I ain't going to stay there long. It's going to come back down. Between the dilution and the debt and the fact that there's just never going to be enough oil to drill for them to pay off those debts, they're going to have to dilute more. They're going to have to cut a deal with Buffett and Icahn. But I think the best that people can hope for is that for some reason, Warren Buffett wants to own this company and it becomes part of Berkshire Hathaway. I don't think he's going to do that. We'll see, because he won't throw good money after bad. Definitely a company in secular decline. So if you want to sell some covered calls here, have at it. I think you could probably sell the 20s because you want it to get called away. Get your buck 33, 6%-ish, and it still goes up a little bit for you. WE Energies usually gets assigned a premium in the utility space. They own a big hunk of American transmission, and it's now getting to, I had some comparisons on here. I guess it doesn't hurt to keep those there, right? So when I did these comparisons, you can see which companies did the best. Excel and WE Energies were close together. These companies were all close together. And then NextEra and Brookfield both did better. Brookfield Renewable. I think you're entering a low volume zone. Pretty easy to see that. So the question you have, well, it's come down with sellers. For it to go back up past about here, past about 100 would be tough. So actually you could buy WE Energies on a trade if you wanted to. I wouldn't. It's not low enough for me. I want that yield to be higher, so I would need to see it at about 85. But if you're in love with it, and I don't think you should be, but if you're in love with it, you know, you could rationalize that it's going to jitterbug in here. I think you're speculating. I think you don't really know. So this is probably a stock that I would just ignore for right now. There's no way you're going to get anything in premium for an $85 put. If you already own it, it's even hard to write a covered call on because you probably don't want to write it, you know, except for maybe at 100. So let's take a look at these. The $100 covered call you don't get anything for. The $85 put you don't get anything for. I think if you own it and your intent is to own it, you're not doing anything right now. I think you missed your chance to write the covered call up here. And I don't think it's ready for adding to the position. And you can't get anything on the options right now at prices that make sense. Let's finish off with some healthcare. We've got some ABBV. Again, entering a low volume area, which means who are the buyers going to be to push it up? Could it rally up to 120-ish? Yeah, for sure, right? You get up this line. So if I own it, I probably hold on to it. I don't think I'm getting anything for the covered call that makes it worth my while. You're not getting anything for the 120. Yeah. And I don't know what this is. So somebody would have to tell me what type of strategic transaction they got cooking. So I think this is another one where I think you could probably trim the stock or write a covered call, and you're going to have to resolve to be happy with only getting, you know, selling at a lower price. So if we put in 110, still not getting much. Yeah, I don't know what's going on with ABBV. No. So people keep asking about longer duration calls. Here's the problem. We know that the stock market is overvalued right now. We know that the Federal Reserve is going to have less firepower after January 1st because they had a bunch of money taken away from them from the Treasury Department. We also know that both of the stimulus packages that they're talking about aren't really stimulus packages. They're just relief efforts. The Republican one doesn't include anything for unemployed people other than a short extension of low benefits. There's not an extra $300 or $600 in there for them. And the Democrats are really only at this point only looking at $300 extra dollars. They've pretty much come off of the $600 extra dollars. So there's not really any stimulus to speak of. And unless the Democrats take the Senate in January, you're probably not going to see any stimulus. And even if you do, it trickles into the economy over a longer period of time. So I just think you ought to buckle up here, and you should more likely than not sell your stocks to Santa, because we're probably going to get a little bit of a rally here into year end, because that's what happens in up years. But the January effect, which is made up of employer contributions to retirement plans, and then people making contributions on their own to retirement plans, it's not going to be there this January. Unemployment's way higher. And it includes lots and lots of people who got laid off from pretty good jobs in the last couple of months. Millions. So I wouldn't expect much of a January effect this year. With the Fed backing off a little bit, with the dollar finding a support line, right? We were just talking about that on Forex Analytics this morning. They have had 88 to 90 apparently as their target for the dollar for a while, which is what I've been telling you since May with the chart that I put together. So again, I tell anybody who's real aggressive here with wanting ownership of stocks, take a look at the charts, because they are literally screaming at you that you should be a trimmer, not a buyer. And ABBV, I think it's unlikely that they break out up to here. And especially I think it's unlikely that they go past. I mean, this is a company that really has been, you know, chopping along for what, 2 years now with a downdraft and all the stimulus, right? Because the Federal Reserve started printing money last September, coronavirus crash, bunch of printed money, and foreigners. And that's something I'll talk about in an article soon, and we're going to talk about it on Friday, is that the research is in. The money that caused the V-shaped recovery in the stock market was foreign money, and the margin and covered call and the option trading, the calls, the long calls, are what's been keeping it up. So unless you have some sort of love affair story with this, where you truly know why it should go higher, and I sure don't. I haven't studied it a lot. I pretty much stopped studying it a couple of years ago because I just knew they weren't going to be exciting for a long time. They kick out a dividend. Merck, which is the one that I think ultimately wins the vaccine war, been chopping around for a while. Chop, 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 chop. Did weirdly well in 2018. They got their correction a little bit later. Started before coronavirus. Merck to me is a company that is one of two things. It's either going to break out to a higher trading range, or it's just going to keep chopping along. I don't really know what the answer is. I think I probably want to get rid of this. I've had a hard time throwing out this 2015-16 level just because it's been so long since we've been down here. But it's not hard to see that that's where the giant support is in the 60s. 618 line right there, which is what I had it pegged to. I do think that the story with these guys, though, is pretty straightforward. And that's that they're probably going to be the winner with the coronavirus vaccine. If I had to bet on one company, this is the one that I would bet on. I'm not making that bet. But could you sell a cash secured put here? I don't think so, because if it goes down, it's going to go down quite a bit, all the way down in somewhere in the 60s probably. And if it breaks out, it could take off, but you're going to have to get good news. So I guess the cash secured put strategy here is you're trying to get it put to you because you want to gamble on it going higher. But if that's the case, with their big fat dividend, why wouldn't you just buy the stock? I know a lot of people want there to be an option trade. I'm not sure what it would be. Sell the $80 cash secured put, I guess, get a couple bucks if you want. But at 82, why wouldn't you just buy it? 80, it's 80.50 right now. If you believe in this stock long term, I think you just start to nibble. And then you have to buy more if it gets down here. And if you're not sure, stay away, right? This game doesn't require you to swing the bat. So for me, I'm probably needing this to get into the 70s somewhere, and it's close, right? So it's close. You're not getting a whole lot for the options though. 53 cents, $1. I'd let the stock move more. Let the stock tell you what's coming. Either it gets cheap, or it starts to break out and you jump on. It's not going to have news on a virus vaccine for a while, and that's what you should be looking up with them. Is do they have news coming soon? What are their results going to be? I bet they have some sort of reporting in the first quarter. And if that's the case, then if you really want to speculate on this, you go the other way and you buy some short-term calls. You buy some April, May, June calls, whatever is appropriate for when they're making their announcements. Bristol Myers, right? Here's their sideways move. They broke out earlier than a lot of companies, but still pretty range bound. So is this an exciting chart? Giant company has to keep coming up with product to stay relevant. Guess you can get a little bit of premium if you just want to write it, right? This is one of these stocks where these super range bound stocks, if you want to buy them near the bottom of their ranges, ride them up and then sell the cover call, you can do that. So like here, if you wanted to buy Bristol Myers in the low 40s, you could. Now, if you own it from a price, I guess, below the yellow line, you could conceivably sell a covered call right now or trim. But if you're trying to own this because you take the dividend too, say, okay, what I get for the $70, say the $65 cash secured, covered call, nothing. You're getting nothing. And even if you go out further, right? And my fear with going out further is bad things can happen between now and then. You're still not getting a lot. So I think Bristol Myers is a stock that around 50 you can buy it. As it gets into the 60s, you got to look at trimming it. And you could sell a covered call. If you really wanted to own this long term, you could go out to June, still not getting much. Go out to January, still not getting much. And you're severely capping your upside if they have a breakthrough drug, which they do once in a while. So I don't know if you want to cap yourself on this, given how low the premiums are. If the premiums were going to get you 20% for a year, then go ahead. But I would need this one be like $13. Otherwise, it's just not worth my time to know that, if it goes to 60, it goes to 160 on a new drug or 100 on a new drug or whatever, it goes above 65, I'm still capped at 65, $70 with with the premium. So don't be in a hurry to cap your potential gains on anything that can have big fits of volatility. If you're in this, clearly you're okay with a stock that goes sideways and you're just collecting a dividend. And probably that dividend keeps coming. And probably this is one of the things that is as close to owning a high yield bond as you can get. But I bet if you compared their debt to the dividend they pay, I bet they're not much difference. And I would wonder if you make more money buying the high yield debt on the sell-offs in the stock. I would bet that you do. So these stocks that go sideways like this, I would encourage you to not want them. They're not worth the single stock risk. I mean, what if something comes off a patent, they have nothing to replace it? You can see this can get all the way down to 30 again. You say, oh, no, it can't. Oh, yeah, it can. So if it gets through here and there's no buyers, it's an air pocket. Go all the way back down here. That's why I don't like stocks like this. That shape right here should scare the heck out of you. If it gets down here and there's not some intervention to help it, that next level down is a doozy. So you need to start recognizing the shape. You better know that it's going to stay up in here. But there's nobody hankering to buy it as it goes up. So the only thing you can do is know your company well enough to know, okay, on X date in February or March, they're going to have data on their coronavirus vaccine. And that would be more Merck than Bristol-Myers. I don't know what Bristol-Myers is developing. But Merck, right, same kind of chart pattern, air pocket, then way down here in the 60s. See if we can get more visibility. There we go. So this one, it would have to break through a lot of levels. I think this is the most likely area to get to, 60-ish. I find it hard to believe that it'd get way down here. But it's not that it can't. Just there's lots of buy-in here. Even there's still buy-in. But this one here, Merck, this one's probably going to be in the swing trading section. This will be in the swing for the fences section soon. Because I'll look up when they're going to have their data results. And I think it's probably going to be positive. So if all of a sudden these guys have a shot available in August, September, and it's not 2 shots and it doesn't have to be frozen and it doesn't mess with your RNA or DNA, then this is the one that I think wins. And this is the company that usually develops that stuff. And they have 2 in development. One that's a shot and one that's administered orally, I believe. I'm trying to remember if they're also the ones that have the spray in the nose. I think that might be Novavax, right? Somebody brought up Gilead. Yeah, so Gilead is really oversold. They were on the stock rover chart. And this is one where I think with Gilead, you take a look at it and you say, okay, what do I think about this company? Well, they're paying me a dividend, right? So Gilead, I think, we'll finish with them. I think Gilead is one that you take a look at their visible range, and one of 2 things is going to happen. Either they're going to fall all the way down into the 40s, which is what I would be afraid of, right? Who's going to buy the stock right here? Looks like the buying starts to pick up down here. And this looks like it's going to fall off a cliff. Do you expect this line to hold? I'm going to give you a big fat I don't know. Look, resistance, breaks through, tests it, all above here, came down and tested it, came down and tested it. Now it's testing it again. I mean, what if Gilead goes all the way down to 30? I don't want to sell puts on this. So to say it's at the bottom of its range doesn't take into account that there's no buyers in here. Now, part of that is because it hasn't been down here for a very long time, right? So you have to take that into account. But that doesn't look strong, does it? It looks like right around here is where you get your buyers, right around 40. Maybe that line right there, 46. I think it's going to go below this line. I don't know how far it's going to go. Not oversold on the weekly yet. Clearly it gets there once in a while. I think this is a tough one. So I think this is where you have to ask yourself the question, is Gilead truly a value right now? Or is it a value trap? I don't know the answer. I don't know the answer. They just bought something, didn't they? An Alzheimer's drug or something? So you need to ask yourself, is there accumulation going on here? It's hard to say, right? You know, if we just want to look at the 1 year, a little bit of accumulation going on right here. Not great, but if you don't think that they're going to break down, then maybe you take your 1% starter position here. and say there's smart buyers in here. And that's why it's jitterbugging. It's putting in a base. Maybe that's what's happening. At 4.6% dividend yield, maybe you're willing to take that chance. But you saw what the downside is. The downside is clearly to approach 40. I don't know if that's going to happen or not. There's enough uncertainty that I don't think I would buy it unless I knew there was a product that was going to push them back up here. I don't know the answer to that right now, so that's something that you have to ask. All right, somebody asked about GDX puts. I said last week you could sell GDX puts. Little air bubble here, but then buying right around 30. So if you wanted to sell a $30 put on GDX, I don't think that's a horrible idea. Again, I don't know what the premium is. Not really getting anything, which means there's not a lot of risk. So, you know, I don't think there's a lot of risk. Big buy-in right underneath it. So it might hold that 33 zone that we pegged. I mean, look, it went right to the lines that we had set up. Right there it hit. So for all the folks when a stock or something's up here, you go, but your buy zone's way down there. Look at how often it happens. When you're a position trader, you don't have to be perfect day to day. All you have to do is get this big picture right, and you're going to buy pretty low pretty often on good companies. Now, if there's an air pocket here, it still only goes down a few more dollars. So if you don't own GDX, I think you can buy it. If you don't own enough GDX, I think you can add to it. Would I go all in, all the way back up to 16%? I don't know that I would do that just in case, but I think you're probably pretty solid here. These companies are churning out more and more and more profits and bigger dividends as a group. So to me, this is a core position. And eventually, as I've said, there's going to be helicopter money someday. It's not going to be QE. At some point, they're just going to print money because the unfunded obligations are so high that unless somebody like a Trump of the future could cut benefits on the elderly and on retirees and somehow get them to vote to have their own benefits cut, it's not going to happen. There is enough people who vote against Trump from all different groups to make you know that as the boomers get into retirement, the odds of them voting their Social Security and Medicare away are almost zero. So I think gold stocks remain in a bull market. This is just a consolidation, and it's going to have another leg up, and it's going to be significant. So you need to consider what your asset allocation is and what you want to do about it. But it's clearly in the buy zone. It's not as low as it can go, but it's pretty close. All right, everybody have a great rest of the week, and I've got some videos to edit and some summary articles to write.